Global shifts, local impacts. We connect the dots so you don't have to. From the Biz News studios, welcome to Biz News Daybreak for Wednesday, the 18th of February, 2026. I'm Alec Hogg. Well, the Rand starts this Wednesday at just weaker, slightly weaker than 16 against the US dollar. Gold is just below $5,000 an ounce, and Bitcoin is now trading at $67,500, still under pressure there. On Wall Street last night, the S&P 500 and the NASDAQ index, both of those were up slightly, 0.1%. But there was some interesting moves underneath that. Apple continues to surprise. That was up by 3% last night. And Nvidia picked up 1%. Nvidia now trading at $185 a share. ASML continues on its merry way. That was 1% better. And Google was 1% lower. On the Johannesburg Stock Exchange, big wipeout for Afrimat. More on that story in a little while. But now let's pick up on the latest news from offshore. Here's Doug Krisner of Bloomberg.
Crude oil prices declined. That was after the U.S. and Iran made progress in nuclear talks in Geneva. Tehran's negotiators are scheduled to return with a new proposal in 2 weeks. Now, that may suggest reduced chances of any imminent military clash. Here is Evelyn Farkas, Executive Director at the McCain Institute.
I don't think that I would put too much stock in it, in the sense that when President Trump has two carriers off the coast or, within striking range of Iran, it usually means he's going to use force just based on past recent experience a la Venezuela. So I think that President Trump is pretty much leaning towards using force. The Iranians don't want him to use force. So, of course, they've agreed to some kind of framework.
That is Evelyn Farkas from the McCain Institute. There is simply no mistaking the disruptive power of artificial intelligence. Anthropic released a new AI model aimed at using PCs in increasingly complicated ways. Claude Sonnet 4.6 can carry out actions that require multiple steps, such as filling out web forms and then coordinating information across several browser tabs. Now, the equity market remains anxious over the ability of AI to disrupt many businesses. Software stocks in particular have been punished, and in some cases, so has the debt associated with those companies. A handful of software firms released earnings ahead of schedule to show their resilience. Nonetheless, the IGV software ETF was down 2.2%. Here is Julie Beal from Kane Anderson Rudnick.
It's very likely that AI is going to disrupt all of us in a pretty meaningful way, but it's not clear to me, and I don't think it makes a lot of sense to be directing a ton of client money based on very unproven facts. Many of the companies that are coming forward and purporting to be disruptors, these are Silicon Valley darlings that, have a great amount of rhythm and they have lots of growth opportunities from them, but they haven't actually demonstrated the hardest thing, which is the distribution and the ability to sell into enterprise. And that is much tougher and takes much more time to figure out.
Julie Beal there from Kane Anderson Rudnick. Now, at the same time, the Fed is trying to assess the impact of AI on the American economy and productivity growth. Here is the head of the San Francisco Fed, Mary Daly.
So what we're looking for is a technology to give us consistently good changes in productivity so that all industries at scale get better. Industries figure out new ways to generate revenue, new ways to do product design, new ideas to come and shape the economy. That's the thing that has a sustained productivity growth part. So it's undeniable productivity growth has gone up. What's not as clear is how long will that last.
That is San Francisco Fed Bank President Mary Daly speaking at San Jose State University.
From load shedding to load shifting, South Africa's water crisis is rapidly becoming the new electricity crisis. Well, we had load shedding before, and we were warned that electricity was only the beginning of the nonsense. Now we have to deal with water, or at least in vast parts of South Africa. Taps are running dry across the country. The DA's Stephen Moore spoke to my colleague Chris Steyn, saying that the government's new Water Crisis Committee that Cyril Ramaphosa, the president, announced in Sona is, in his opinion, just more red tape. He reveals the shocking statistic that Johannesburg is losing nearly half its drinking water to simple leaks, while in the west, in Mogale City in Gauteng, a staggering 80% of the water bought by that metro doesn't generate a cent.
Words are something we've heard before. We've now shifted from the deputy president who's heading up the water task team to now the president himself is going to head up a task team. That's great. As long as he has the time to actually do something with it, because I'm to this day not entirely sure what the deputy president did with the task team. I'm not sure what difference he made to Gauteng, because these water outages were completely anticipated. They were to be expected by anyone who understood the system and understood the trends that we were looking at. And I didn't see any preventative action. So yeah, I'm glad it got the attention it did, but time will tell whether it gets the money attention, the actual time attention, the physical attention on the ground by ministers and the president himself.
Now we have yet another committee, a National Water Crisis Committee. What do you think that is going to achieve, considering that warnings of a water supply crisis going back over a decade were not taken particularly seriously?
Chris, I'm not sure what they're going to achieve, to be honest with you. Again, this is now the president's committee as opposed to the deputy president's committee. And it's not like there aren't a half a dozen other bodies who have this type of responsibility. I'm always very hesitant about creating other sets of oversight, especially when the challenges are known. The challenges aren't at some level that we need to discover, have a dialogue on, have a committee to investigate. It's the massive non-revenue water in so many municipalities. Joburg is a good example. Their non-revenue water is between 44 and 48%, depending on whose report you believe, which report you read. And to put that into a scale, just the losses, just the physical losses, so those are leaks, for Joburg means over 400 million liters of drinkable water are lost to leaks alone. That's not all the water they lose to non-revenue water. That number is closer to 700, 800 million, megaliters a day, so million liters a day. But to lose over 400 million drinkable liters a day to leaks is terrible. And I mean, obviously Joburg's the big number, but I got a stat 2 days ago from Mogale City, and their non-revenue water, Mogale City, for those who don't know, Gauteng, well, is a smaller municipality on the west of Gauteng. Their non-revenue water is at 80%, which means that 80% of the water they buy from Rand Water, they don't get paid for, and is lost in all sorts of various ways, but also largely to leaks.
Finalizing your February tax planning? Jaltech's latest Section 12B solar investment offers taxpayers a tax deduction of up to 230%. In simple terms, for every Rand invested, up to R1 can be deducted from your tax bill, while you continue to earn income from solar assets. This applies to both income tax and capital gains tax. Visit jaltech.co.za to find out more.
The Tongaat Hulett saga is finally concluded, but the damage is done. I picked up on yesterday's news by having a chat with former banking executive and analyst Dave Willem. And in this clip, you will hear how he dissects the collapse of this 100-year-old sugar giant, revealing how overly optimistic forecasts and a desperate scramble for cash led to its downfall. Willem argues that business rescue practitioners made a fatal mistake by fighting statutory levies in court, a fight they could never win, and also in the process alienated the very industry that they needed on side to survive. He unpacks the 1.5 billion Rand blow to the small guys, the growers and the millers, and asks whether the new owners can salvage what's left of Tongaat Hulett, which once was the iconic industrial giant of the KwaZulu-Natal province.
There was always an overly optimistic view being presented, and eventually the banks just drew a line and said enough.
How much did the banks lose in all this?
It's a good question. So how much capital did they lose? How much interest have they accumulated? So if you go back to the original debt, it was about 11 billion. There's 12 billion. They sold starch. They sold Namibia. They actually did a pretty good job at raising about 6 billion of cash, and they paid down the debt to about 5.5 billion in 21. But the bankers weren't happy, and rightly so. I guess they were saying, listen, you promised an 8 billion reduction in debt, you didn't make it. So the screws got put on. Default interest rates were put in place, 20% interest rates. So this debt has been growing at 20% per annum interest rates, the likes of micro lending and unsecured lending. And it is now accumulated to 11.7 billion. No further grants of loans, no payments back. It's just a ballooning. So you've got about 6 billion has doubled to 12. Has the 6 billion of interest that has been suspended rightfully owed to the lenders, in this case now Vision? I don't believe so. I believe there should have been a suspension of that debt. I think the banks could have and should have done a haircut on that debt, and that would have allowed all parties to come into the room and see that the sledgehammer hanging over the company had been somewhat taken away. No equity provider was going to put money into the company while there's 11 billion of debt hanging over their heads. And so this was a stalemate caused by, to a large extent, the inability to just accept reality. In the end, the bank sold that debt for 3.2 billion.
In the South African operations, the farmers in this country, those who had an exposure to Tongaat Hulett, what happens to them?
Well, the sugar industry is an extraordinarily integrated industry. It's integrated in a value chain, and that's why we have the Sugar Act and the Sugar Industry Agreement, because at the end of the day, you have a whole lot of cane being grown, ultimately gets crushed, gets made into raw sugar, then gets refined into refined or commercial grade sugar and sold. And some of it's sold locally, about 2/3 to 3/4, and the rest is sold internationally. And it's all governed under SASSA and the Sugar Act and the master plan. But essentially what happens is everything is pooled, and then everyone gets a share of the pie between the millers and the growers, and between the millers and the millers, and between the refiners. The problem with all of those is whenever you have a formula that dictates how value should be shared, people spend more time trying to arbitrage and think how they can steal a bit more than they are entitled to, because that's all they can gain. The business rescue practitioners, I believe, made an absolutely fatal mistake by going to court to fight the SASSA levies that were due and payable at the time of business rescue, 500 odd million. Bear in mind that these are statutory payments under law. They ordinarily are not capable of being suspended, but more importantly, they bit the hand that feeds them. The industry operates in a collaborative way. So all that it did was lay down a gauntlet, and everybody has responded. And that's why I believe we've seen imports from Eswatini uncontrolled. Everybody is, I think, in a way what they did is they declared war, and then everyone now is playing war, which is the worst outcome for the industry.
Robertson, a small town in the middle of nowhere where a wine farmer claims to have sold a Volkswagen up to WeBuyCars. A farmer. What car did you really sell them?
A VW up.
Right here in Robertson.
Small town, but we know about WeBuyCars.
Yeah, but what's a farmer doing with a VW up?
It was just a runaround.
Cool cover story. And I see you traded it in for this, like a double cab Renault. Were they all out of ranges?
WeBuyCars, the easiest way to sell your car by far.
JSE-listed Blue Label Telecoms is evolving beyond selling just airtime. It's entered into the power game. The group officially received a license to act as an electricity broker and announced it yesterday, the license, of course, coming from the regulator, NERSA. This means that Blue Label can buy renewable energy from private producers, those IPPs who've got apparently electricity to burn, and sell it directly to consumers. The secret weapon is its partner, Sigicel, which already manages prepaid electricity for 95 municipalities. Sigicel's existing footprint allows the duo to step in quickly to help fix local grids in smaller municipalities and manage the connections. Here's Dylan Bradfield, portfolio manager at ShareNet Wealth, who has been on the money on Blue Label over a period of time. In fact, he was telling the Biz News tribe to get big in the stock when it was a lot lower than its current levels. His view then was that the Cell C listing would be very good, or the Cell C investment rather, and subsequent listing would be very good for Blue Label. That's the way it's turned out. But now Blue Label's getting back to its core business. And, well, Dylan's even more excited. You can pick up the full interview, but here in this clip, he explains why this deal could be a unicorn moment for the company, potentially unlocking hundreds of millions in monthly revenue.
Yeah, it's the unicorn. It's the unknown right now. I mean, I think post earnings results at the end of the month, we'll have a bit more gateway to ask the questions. But from early interactions we've had, this is something that's been 3 to 4 years in the making. That converted a couple of municipalities across. And I think one of the easier ways to think about it is you've got a big brother that's going into the municipalities where Eskom has failed horribly. That's there to revive the services, to make sure that all the prepaid electricity is accounted for correctly. The gateways are paid for. They've hired, through government subsidy, circa 10,000 employees that will effectively roll out into the country for illegal disconnections or connections, to disconnect all of those, put the prepaid meters within that they service, and that's pretty much their whole gateway. And then you've got, as you said, the IPP that's going to be coming through, where you can sell and distribute electricity to areas that need it. I think it's a fantastic thing for Blue, but I think it's a fantastic thing for South African economy on a whole.
The IPPs, the independents, haven't been able to really break through, but this would give them a route to market.
Yes, absolutely. It's an exciting, we don't know the exact timeline and how this will start to focus and to roll out. But I think, as I said, they've already interacted with a couple of municipalities. I think it's a couple of months versus a couple of years from where we are now.
And it has got the impact, as you said, of being a unicorn for the bottom line of Blue Label.
Yeah, I think, some earlier numbers in our suggested comments were, it could be a 300-400 million per month sort of revenue cycle for Blue with extremely high margins. And that's just the starting point. It's really unknown how big this can be. It's been part of the Blue strategy for 4, 5, 6 years now. And the fact that they've gotten this nurse license, I think it's just fantastic. It's just one of the multiple growth strategies that's starting to come through.
The weighing machine has spoken. Cy Jacobs and Sean Pesh dominated the 2026 Raging Bull Awards. They were presented last week. Now, come and hear these market masters live. Piet Viljoen will be there as well, and so will Anthony Ginsberg and Pete Major. You've really got the A-Team Plus at the BNC 8 in Hermanus. We have a special investment masterclass starting on Tuesday, March the 10th. The conference runs through until the 12th. Other heavy hitters are there too. Tickets are going fast. Book yours right now at biznews.com. Telkom is flexing its muscles in the data war. The group's third quarter update, released earlier this week, shows data revenue jumped nearly 10% and mobile subscribers surged past the 25 million mark. With profit margins widening thanks to strict cost controls, management says the data-led strategy is firmly on track. I asked Dylan in the interview yesterday to unpack the numbers and tell us what they mean for the share price. He came back with some interesting insights on maybe an alternative.
We were on par with what they delivered. Year-on-year growth just under 3%. It's very difficult to knock out anything in the high single digits right now in the South African market, but also trending nicely on their EBITDA. With the margins around 29%. I think if you look across for Cell C, they're around 23. They'll normalize towards 25. And just to make a quick comparison, we've got a nice story going through with Telkom with their EBITDA around 3.2 billion. CapEx has increased a little bit. If we take a comparison against Cell C, they're trending towards just under 3 billion EBITDA. So very comparative in terms of the EBITDA, but you've got a Telkom on a 30 billion market cap, and you've got Cell C on a 10 billion.
It's been a big week for telecoms, and more news came late yesterday on the Stock Exchange News Service when MTN announced it will acquire the remaining shares in tower operator IHS Holdings in a $2.2 billion all-cash deal. Vodacom, you might remember, spent a similar amount of money buying out a huge business in Kenya. MTN already owns just under 25% of IHS, and this transaction, structured to execute once IHS has disposed of its Latin American assets, will see MTN take full control of IHS's African tower portfolio. Management at the group says owning the infrastructure end-to-end strengthens its strategic position against currency volatility and inflation, and that there are immediate savings from lower lease payments. Good news at last for a company that's been under the cosh given its exposure to the Middle East and the turbulence that we've seen in, Syria, it managed to get out of, now Iran. And finally, Afrimat shareholders took a hit yesterday, and that includes members of the BizNews tribe. It's in our portfolios, as the stock shed nearly 8% following a trading update that laid bare the cost of South Africa's treacherous, as the CEO called it, economic environment. While the construction materials division at Afrimat is performing well and boosted by the recent Lafarge cement acquisition and new road orders, investors were spooked by the collapse in bulk commodity prices. Domestic anthracite volumes were slashed in half due to customer smelter shutdowns, and that forced a temporary mine closure, while iron ore exports remained choked by Transnet's rail failures. Management at Afrimat says urgent political intervention is now critical to protect the local industry, and the CEO describing the business environment as treacherous signals deep frustration with structural failures, rail, power, trade protection, very much out of the control of Afrimat. Well, when the going gets tough, the tough get going. We South Africans, after all, aren't we? Yeah, who said it was easy to do business in our beloved country? But now you have the edge. Stay tuned to BizNews. We'll give you the insight and the information you need to make a difference in your operation and actually to win the day. For the full interviews and details behind these stories in Daybreak and all the others that we publish, go along to biznews.com. I'm Alec Hogg. Thanks for starting your morning with us. Now seriously, go and seize the day.